Welcome to segment 0 of the Executive Masterclass. This is the orientation session and its job is simple. Before we open any of the 6 technical modules, you should be able to see the whole machine. This is the CSO to CFO operating loop. Here is the through line for the next 90 minutes. A sustainability commitment is not financially relevant because it is announced or because it scores well or because it reads nicely in an annual report. It becomes financially relevant only at the moment it changes something a CFO already manages: revenue, cost, capital, cash, or the price of debt. So, we are not going to treat this as reporting. We are going to treat it as an operating system that turns a climate target into financial evidence, evidence strong enough that finance will stand behind it. Everything you see today rides on one fictional company or really a industrial group, so you watch the same facts change form without losing their lineage. By the end, you will know the destination before we teach you the mechanics. Let's start with the problem because it explains why this program exists. Targets are everywhere, financial traceability is rare. That gap is the whole issue. Look at the 3 states across the top. Most organizations have a narrative target, an enterprise pledge, reporting ready language, but only a weak line to whoever actually owns the reduction. Then there's the operating gap. Business units and facilities never get a budget grade decomposition they can act on. And only at the far right is financial relevance, a specific line item impact, a cash consequence, and evidence someone has approved. The failure pattern underneath is what a CFO recognizes immediately. A target is announced, but there's no owner and no driver, so there's no CFO decision. A scenario deck appears with no budget constraint, so it never becomes a planning baseline. A disclosure gets drafted with no source lineage, so there's no assurance confidence. Segment 0 resets that sequence deliberately. Financial mechanism first, narrative last. That reversal is the single most important idea in this session. This slide is the test we'll use all day, and I'd encourage you to keep it in your head after you leave. A sustainability issue is financially relevant when a financial line changes, not before. Run any climate claim through these 7 boxes. Does it move revenue through price or demand? Does it hit COGS through energy or feedstock? Does it change OPEX through carbon or compliance cost? Does it require CAPEX for retrofit or transition? Does it touch the balance sheet through impairment or useful life? Does it change cash flow through timing or liquidity? Does it change the cost of capital through a coupon or a covenant? If a proposal can't land in at least one of these boxes, it is a communications exercise, not a finance decision, and that's fine, but we should be honest about which one it is. So the executive discipline is this. Don't debate whether sustainability matters in the abstract. Ask the concrete question at the bottom. Which line item changes, by how much, when, under what assumptions, and who approves the consequence? 5 parts. Every one of them matters. This is the shift in one picture. On the left, the old sequence: an ESG score, an annual report, a corporate pledge, a static roadmap. Notice what's missing: a mechanism. Nothing that tells you how a number reaches the P&L. On the right, the new sequence: a target with a named owner, an operating driver, a financial line, and approved evidence. The pivot in the middle is the financial mechanism. That's the thing the old model never made explicit. The point isn't that the old artifacts are worthless. It's that the same sustainability fact only becomes useful to a decision maker once the operating and financial mechanism is spelled out. The score doesn't tell the plant manager what to do on Monday. The pledge doesn't tell the treasurer what happens to the coupon. The mechanism does. So as we walk the modules, watch for the moment each one converts the sustainability fact into a mechanism. That conversion is the product. Here is the map of the whole program: 6 modules arranged as a closed loop. Each module produces a governed object that becomes the input to the next one. Module 1 turns a target into a locked gap. Module 2 turns that gap into an approved pathway. Module 3 prices the carbon and produces a carbon P&L, the valuation. Module 4 connects the performance to financing through governance. Module 5 turns effects into disclosure, the financial IROs and the IFRS bundle. Module 6 tests everything against actuals and financed emissions, credibility, and PCF. Now notice the most important arrow on this slide, the one that closes the loop. The program does not end at disclosure. Module 6 feeds actual performance and forecast credibility back into the target and the scenario baseline. That's what makes this an operating system rather than a reporting chain. It learns, and management assumptions get tested against reality instead of being restated every year. Keep this loop in mind. Every slide from here maps onto one of these six positions. Now meet the case. Aurelia Industrial Group is fictional, but the numbers are internally consistent, and we'll carry them through every module so you can see continuity instead of six disconnected exercises. The starting position, a 2025 scope 1 and 2 baseline of 200,000 tons. A 2030 ambition to cut 35%, which sets a 2030 target of 130,000 tons, but the pre-intervention forecast for 2030 lands at 155,000. Subtract and you have the number that drives the rest of the program, a 25,000 ton residual gap. Look at the planning handoff on the right. The approved abatement portfolio delivers 26,200 tons. That's the gap plus a 1,200 ton buffer. Hold on to those three numbers. Why one case? Because the modules stay connected, the IDs and assumptions travel forward, the financial effects evolve as evidence arrives, and critically governance becomes visible because each module consumes the approved output of the one before it. Aurelia isn't a business case for a tool, it's a complete evidence chain from target to actuals. Module 1. The question it answers: where is the gap and who owns it? A science-based target is useless until it becomes an operating and financial baseline. Follow the chain across the slide. The corporate target, 35%, gets allocated down to business units using explicit drivers and weights. That produces facility level gaps, each with a named owner and a forecast. Those gaps then map onto real financial lines, COGS, OPEX, CAPEX, and the whole thing gets locked as evidence with an approval and a version. The interpretation is on the right, and it's worth saying slowly. A target isn't useful until it has an owner. The owner acts through operating drivers. Those drivers become financial line items. And the approved lineage feeds every later module. What Aurelia carries out of module 1? The 25,000 ton residual gap plus the target and financial line IDs that everything downstream will reference. This is the module where the machine allocates and reconciles, but a human chooses the allocation logic, and finance and sustainability jointly approve the log target. That division machine calculates, human owns is the pattern for the whole program. Module 2, we have a 25,000 ton gap. The question is how to close it, and specifically how to close it in a way finance can actually fund. This is where the machine earns its keep. It takes the gap, applies a scenario envelope, NGFS and IPCC pathways, price and risk assumptions, financing assumptions, and runs a lever optimizer across options like power purchase agreements, fleet efficiency, and materials, scoring each on CapEx, NPV, and marginal abatement cost. Outcomes: an approved pathway of 26,200 tons. Look at the portfolio logic along the bottom. PPA at 7.8 kilotons, efficiency 4.3, fleet 5.6, materials 3.9, pilot 4.6. Add them up and you get the 26.2, which covers the gap with a small buffer. But here's the discipline. The machine generates the combinations, it does not choose. Humans set the constraints that shape the answer: the capital ceiling, risk appetite, technology gates, operational downtime. The optimizer can rank a lever the business can't actually run this year. That's why the output is an approved pathway, not an optimal one. Module 3. Now we turn carbon into money. Carbon becomes a priced financial mechanism, and this is where sustainability starts speaking the CFO's language directly. Three prices, three purposes. A shadow price of $85 a ton used for investment appraisal. An internal fee of $120 a ton used to create real business accountability. And the market price for the external and compliance case. These are not the same number, and confusing them is a classic error. On the economics, a marginal abatement cost curve ranks initiatives by dollars per ton. Avoided carbon liability changes the NPV of projects, and a pass-through test tells you how much of a carbon cost you can recover in price versus how much hits your margin. That produces a line item carbon P&L, revenue recovery, the COGS and OPEX carbon effect, and the resulting EBITDA and margin impact in basis points. The output carried forward is a governed carbon price policy, a carbon adjusted NPV, and a carbon P&L baseline that Treasury will use in the next module. The human decision here is the hurdle rate and the exceptions. The machine ranks, the investment committee decides. Module 4. Sustainability performance now changes the cost of money. This is the module treasurers lean forward for. Aurelia has a $250 million sustainability linked instrument with a base coupon of 5.2%. The chain is straightforward. An emissions KPI, scope 1 and 2 against a threshold, gets swept against the covenant, which returns a status met, at risk, or breached. And that status triggers a coupon event with a real cash impact. The economics are concrete. Beat the target and the coupon steps down 15 basis points. That's $375,000 of annual saving on $250 million. Miss it and it steps up 25 basis points, $625,000 of annual cost. Now the single most important warning on this slide at the bottom. Do not confuse forecast probability with contractual breach status. A model can tell you there's an 18% chance of a breach. That is not a breach. The coupon changes on the contractual event, not on the probability. Machines calculate the sweep and the dates. Humans resolve evidence exceptions and make the lender judgment. Module 5. Disclosure, but done in the right order. Disclosure begins with governed financial effects, not with prose. You don't write the narrative and then hunt for numbers. You approve the numbers and then write. The chain, a scenario output, a risk or an opportunity becomes a financial IRO, an impact / risk / opportunity mapped to a specific line item with a low base high range. That goes through a dual model review that surfaces divergence and confidence. It's assembled into an IFRS bundle with the S1 and S2 sections, and the disclosure factory produces the draft with its evidence attached. For Aurelia, $7.8 million of CBAM and transition exposure, $16.4 million of low carbon opportunity margin, and note the 35.9% figure. That's a dual model divergence that's large enough to trigger human review. That divergence is a feature, not a failure. It's the system refusing to hide disagreement. The output is audit-ready financial evidence that humans approve before any final disclosure language is written. The machine pre-populates the IRO, a human approves materiality and accounting relevance. Drafting is never the same as disclosure approval. Module 6 closes the loop, and it's the module most reporting-led programs skip entirely. Plans get tested against actuals and against financed emissions evidence. Two things happen here. First, forecast credibility. We compare forecast to actuals using MAP, bias and RMSE, and we run drift detection that flags each trajectory as OK, watch or alert. For Aurelia, credibility sits at 84.5% and the trajectory has drifted to watch. Because of that drift, the covenant breach probability refreshes to 18%, which flows straight back to the Treasury decision from Module 4. Second, financed emissions, PCAF and Category 15. Aurelia's portfolio attributes to 2,133 tons of financed emissions, but note the 7 unresolved LEIs because data quality is part of the number, not a footnote to it. This is the empirical spine of the whole course. The program doesn't end with a report. It ends by asking whether we should still believe the forecast and feeding that answer back into planning. That's the arrow that made the loop a loop back on slide 5. Let's pull the whole case into one line before we get into roles and governance. This is Aurelia end-to-end, one case, one evidence chain, and a series of executive consequences. Read it left to right. A 25,000 ton target gap becomes a 26.2 thousand ton abatement portfolio. That portfolio priced becomes a 64 basis point margin effect. That flows into financing as a $375,000 saving or a $625,000 cost. It becomes disclosure evidence, $7.8 million and $16.4 million. Then a credibility reading of 84.5% on watch, and finally 2,133 tons of financed emissions. Say it as one sentence, Aurelia's 25,000-ton planning gap becomes an abatement portfolio, then a carbon P&L, then a covenant and coupon exposure, then financial disclosure evidence, then a credibility and PCF monitoring cycle. The discipline underneath the story is the warning at the bottom. Don't let these numbers become disconnected talking points. Every one of them should trace back to a governed object, a source, and an approval. The chain is the point. This slide is the operating doctrine for how humans and machines share the work, and it governs every module you've seen. Machine evidence expands your choices. Humans own the accountability. On the machine side, normalize baselines, generate scenarios, optimize portfolios, calculate NPV and marginal abatement cost, detect drift and anomalies, pre-populate the IROs. That's enormous analytical capacity and you should use all of it. On the human side, and these are the decisions that stay with people: materiality judgment, risk appetite, capital limits, accounting interpretation, override approval, and external communication. The line in the middle is the one to remember. Never confuse calculation with accountability. A model can rank your projects. It cannot decide your hurdle rate. It can compute a breach probability. It cannot accept the risk. It can draft a disclosure. It cannot attest to it. So the operating rule is at the bottom. Use the machine to generate better evidence and more alternatives, not to manufacture certainty where judgment is required. More capability on the machine side actually raises the bar for the human, because now you're accountable for a decision made with far better evidence. One evidence chain, but 6 different executive questions. The goal of a governed model is that the same underlying records answer all of them, without any two roles inventing conflicting versions of the same fact. The CFO asks what changes P&L, cash flow, and capital return, and decides to fund, defer, or challenge. The CSO asks whether the pathway is physically credible and either approves it or sends it back for remediation. The treasurer asks what value is at stake in financing and monitors, mitigates, or engages the lender. The controller asks whether the number can be reproduced and approves, returns, or requantifies. The audit committee asks where the model or judgment risk sits and challenges or requires remediation. And the business owner asks what operating action they must execute and commits, escalates, or delivers. 6 questions, 6 decisions, 1 evidence base. That's the whole argument for a governed common model over role-specific spreadsheets. It prevents 6 roles from creating 6 conflicting versions of the same financial sustainability fact. When we run the decision simulation later, you'll each take a role and feel how the same Aurelia fact pulls in different directions. This is the plumbing that makes everything else possible. The governed evidence object chain. Stable IDs move the story forward without anyone copying and pasting a number. Follow the IDs across the slide. A target ID for the validated target. A scenario ID for the promoted baseline. Initiative IDs for the lever portfolio. An FMR or IRO ID for the financial effect. An instrument and covenant ID for the coupon event. A disclosure bundle ID for the note evidence. And a PCF run ID for the category 15 lineage. Each one is a stable handle that the next module references instead of rederiving. The evidence rules on the right are the non-negotiables. No material number without a source reference. No baseline without a version and an approval. No recommendation without a stated confidence. No disclosure without reproducible lineage. The line at the bottom is why this matters to a CFO. Lineage is the control surface. When an assumption changes, and it always does, downstream records can be traced, refreshed, and reapproved instead of rebuilt from scratch. That's the difference between an operating system and a folder of spreadsheets. When we move to the live platform, this is the route we'll take, and I want to set the expectation now. This is a 20-minute walkthrough to demonstrate continuity, not a menu tour of every feature. 8 stops, and they are the same 6 modules you already know. The target record, the scenario baseline, the carbon pricing hub, the finance hub and covenant, the financial IRO, the IFRS disclosure bundle, forecast credibility, and PCF with category 15. Here's the narration rule I'll hold myself to at every single stop, and it's the rule at the bottom of the slide. For each screen, I'll answer 3 questions in under 2 minutes. What decision is this screen supporting? What machine calculation is visible? and what human approval or judgment remains. If you ever feel me drifting into a feature tour, hold me to those three questions. The objective is for you to watch one Aurelia case move through a governed operating lifecycle, target to actuals as a single continuous story, not to admire the software. Before we open the technical modules, I want to put one cross-functional decision in front of you. Actually four. This is the executive decision simulation and its purpose is to make the man and machine doctrine real. Four decisions. Do we keep the low carbon material pilot when its marginal abatement cost is weak but the customer value is high? Do we increase transition spend after the watch drift, trading budget discipline against target and covenant credibility? Do we recognize the expected financing benefit in planning when it's a probability weighted estimate rather than a contractual cash outcome? And do we publish the financial effect now given the model divergence and the state of the evidence? For each one, the machine gives you real evidence, a max ranking, a breach probability, a probability weighted coupon effect, a divergence score. But look at the debrief line. The machine never settles these questions alone. In every case, the executive has to record the judgment and the evidence behind it. When we run this live, pick a role, use the same Aurelia fact, and notice how your answer changes with your seat. That's a lesson. This is the governance and assurance spine, and the reason it gets its own slide is that the control pattern is identical across all 6 modules, even though the financial problem changes each time. 6 controls every module. A stable ID for object lineage, a version that records what changed, evidence with its source and method, an exception flag for what still needs review, an approval showing who accepted it, and an audit trail explaining why the decision changed. The assurance questions on the right are the ones an audit committee or an external assurer will actually ask. Can the number be reproduced? Who approved the assumption? What changed from the prior version? What exception is still open? And the failure patterns on the far side are what this spine is built to prevent. Copy-paste facts with no source, hidden overrides, unresolved divergence, and the one we keep returning to, probability treated as contractual status. If you take one governance idea from today, take that last one. A model's probability is evidence for a decision. It is never the decision itself, and it is never a legal status. So what does success actually look like at the end of the 6 modules? Not a beta report, a controlled operating system. Let me name the 6 end states because this is the destination you are being oriented toward. An operating target that's genuinely owned at the business unit and facility level. A transition pathway that's been optimized and approved, not just drawn. Carbon economics that are visible in the P&L and in NPV, not sitting in a separate sustainability ledger. A capital structure that's linked to performance through real governance. Disclosure evidence that's structured and reviewed before the language is written. And a credibility loop that tests the plan against actuals and feeds the result back into planning. The sentence at the bottom is the whole program compressed. Sustainability commitments become financially relevant when they are decomposed, valued, financed, disclosed, and empirically tested. 5 words. That's the operating system. Everything in the 6 modules is in service of one of those 5 words. That's the orientation. You now understand the destination before we teach you the mechanics, which was the entire point of segment 0. Here's what you carry forward from today. The Aurelia case facts, the financial relevance test, the human versus machine decision rights, the evidence object chain, and the end-to-end CSO to CFO loop. Those 5 things are the common language for everything that follows. And here's the question module 1 opens with on the slide in front of you. How do we take an enterprise science-based target and turn it into a controlled business unit, facility and financial line item commitment that finance can budget and approve? That's not merely target setting. Module 1 is where we build the financial operating spine that the other 5 modules stand on. So the next session is science-based target decomposition and financial line item mapping. Come back ready to turn Aurelia's 25,000 ton gap into something an owner can be held to. Thank you.